All right, here's something different. I've numbered these numbers 1 through 15. I'm not pointing out the important days, it's just for reference. So I started by counting the top day number 1, and then 5 and 10 and 15. My question to you is, looking at this chart, what do you think is the future direction on this chart? What is your sense when you look at that chart? What is the look of that chart? Is that a bullish look right there? It's bearish. The last day has a real bearish cast to it, right? The last day colors the chart bearishly. It's always good to have some understanding of what's on the chart. Because if you just look at the last day, sometimes you can be misled. You need to have more evidence in favor of the idea that you should go short the March British pound. Over here at point number 1, notice that we made very little upward progress above these previous highs. Notice how heavy the volume was and how relatively narrow the price range was, certainly compared to these bars where we were moving with ease, indicating that someone must have been selling there. Even though it had a decent close, it didn't make much progress above the previous highs, and there was a great deal of effort at point number 1. That was the heaviest volume at that time. So it had to keep going, but it didn't. Instead, the next day, it breaks with ease on even heavier volume. It's true, it comes back and closes well off the low, so somebody's buying, but the ease of movement and the heavy volume still rates it more towards the bearish side. The next day, it's a similar thing. We have some downward progress. We're coming back and closing well off the low with a lot of volume. It looks like it's trying to find support. But here on day 4, the market goes down, and notice the volume now, and it closes well off the low. At day 4, it seems as if the selling pressure has abated. So then the market rallies. Look at day 8. When I look at markets, when I look at a trading range, the first thing I do is I draw a line of resistance across the immediate high, which is right here, across the high of bar 1. And I draw also a line of support underneath the low of bar 4. And that's my trading range. Markets spend most of their time in trading ranges. I'm interested in knowing when they're getting ready to come out of those trading ranges. Trade's about to happen. And I think it's pretty clear that a trade is about to happen on this chart. But I'm trying to show you that there's more than just the look of the last day. Something that's very bearish on this chart is day 8, where it rallied above the top of the trading range and failed to hold and reversed downward. In many ways, this day 8 is similar to this day here. Well, I guess the next day. It didn't reverse the same day. But over here we had a drop below support with no follow-through. Here we have a rally above resistance and no follow-through. That would certainly key me into the possibility that this stock or this future, this currency, is poised to move lower. But it all doesn't happen in one fell swoop. So the market holds and tries to rally. Day 9 and 10 are inside day 8. This is on day 10, we have the highest close on the chart. That's its best chance to go up. No follow-through. Down we go. Then we rally again to point 15. Look at the position of the close. Now we have a lower high. This is a great place to decide to go short. Then the market breaks with ease. But what makes the last day so bearish? On the last day, we rallied above the highs of the 2 previous days. The bulls made one more good effort on the last day. They took out the highs of the previous 2 days, and there was no upward follow-through. They couldn't hold the gains. And instead, the market reverses and closes near the low. And it's just like me playing with my grandson and stacking blocks up. there's a point where the tower of blocks will tip over. And this is it on this chart. Okay, you want to go to the next chart? This is the euro currency right here. I've marked, again, day 1, 5, and 10, just to have them in order. The question is, do we think the market over here at the right-hand side is poised to go up or down? Anybody volunteer an opinion?
I think
down. Down? Let's take a look. On day 1, we have the second heaviest volume on the chart. Notice that it closed off the high, but still closer to the high than the low. It holds for 3 days, and actually on day 4, it makes a slight new high and reverses downward in a rather ugly manner. On day 5, the selling stops. The market recovers and closes somewhat off the low. The next day we do get a bounce. And we hold within day 5 for the next 3 days. And day 9, what's the implication of day 9? Like we saw in the March pound, here it goes above the highs of the previous 4 days, right? It looks like it's going to break out if you're watching it intraday, but by the end of the session, we're closing near the low. Certainly a bearish connotation. The next day it tries to rally. It's unimpressive one way or the other. But day 11 is a key day. Draw a line of support under day 5. And you see that the market on day 11 goes underneath all of these lows and recovers to close way off of the low. In addition, the market moved up with great ease, almost vertically here, with a lot of volume, 2 days before number 1. Markets have a tendency to return to high volume vertical areas. You see the rally to number 1 is testing the vertical area here where the sellers overcame the buyers. Now on this pullback, the market is testing the area where the buyers overcame the sellers. So I would say that the odds favor that this is a spot to make the bet and put the stop just underneath the low. Day number 1 I just chose because it was the high point at that time. I thought that at day number 1, if I had been watching that in real time, I would have said, here's a lot of volume coming in, and notice the position of the close. It's still a higher close, but obviously somebody was selling for the market to drop that much off of the high. And then secondly, I'd be looking over to the left, and I see where a lot of people were trapped. Here's where many longs were trapped, and some of them had the fortitude to stick and hold it out in hopes of a recovery. So we've come back up into that area, and that long liquidation is taking place again. It's at day 11 that I think shifts the weight back to the bullish side. Day 11, we go underneath the lows of the previous 6 days and don't follow through. So that interests me. Again, buying at the danger point where the risk is least. Instead of waiting for the market to get back up to the high, if I buy it up here, where do I have to protect? If I want to give it a chance, I'm probably going to have to protect somewhere back down here. And every one of these points, these pennies or whatever in the euro is $1,250, right? So that's a little rich. So I want to be able to risk half a penny or a quarter of a penny. Let's go to the next chart. This chart right here. I think this might be the Australian dollar. One of my favorites. Anybody want to tell me what they think will happen next? Will we go up or down? I think so too.
You think it's going to go down?
I think it's going to go up. And we've got an increase in volume. So I think this is a more bullish situation, and it was. You know, we're always looking to buy on reactions or in bases, but there are plenty of times you can buy in midstream if you can create a story about what you think is going on. I have one more chart, maybe that we'll discuss today before moving to the next section. Someone asked me, am I using any indicators? I'm really not. I don't use RSI or MACD or momentum curves or moving averages. I'm just looking at price and volume. I used to spend a lot of time working with stochastics and trying to find divergences, and as I told Alex, will the real divergence please stand up? In an uptrend, there are lots of divergences that fail. In a downtrend, the same thing. In a trading range, however, these devices sometimes have more helpful, for me at least. All right, let's take a look at this chart. This is March 07 cotton, which I'm trading currently. I've labeled again 1 through 20, starting at point number 1, just because it's the high on the chart. And at point number 1, you see that we didn't make much upward progress above the previous high, which is right here. This high made a lot of progress above the high of the 24th of July. From here to here is good upward progress. But from this day to the high of bar 1, there's less upward progress. And that's usually reflected in some kind of mathematical indicator as well, that momentum is tiring, and that therefore you're probably getting some kind of a divergence. But I'm very interested to see when the thrust of an up move is shortening. I didn't come up with that. Wyckoff came up with that in 1909. Shortening of the thrust. Observing when the market is growing tired, just by how much progress it makes from high to high to high, and in a downtrend off of lows. But in addition, on day 1, notice the position of the close. On this day, the market closes way off the high and actually underneath the high of the previous day. And of course, well underneath the high of 2 days back. So obviously, the market is running out of demand. It's getting tired. We can't say that anything overtly bearish has occurred here, but it just looks tired. On the next 2 days, there's little movement. And then on day 4. Now here is a day where the market went down and up and closed higher for the day. And it really looks like it's poised to move upward. This looks like a great recovery. And on day 5, there's no upward follow-through whatsoever. Now remember, I'm evaluating this chart from the right-hand side of the graph. I'm just looking back in time. Say I've been in Tahiti for a week, or 2 weeks if I go to Tahiti. And I've just been looking at March cotton, and the first thing I see is the shortening of the thrust. The second thing I see is at bar number 5, the lack of follow-through after the rally at bar number 4. And then the market continues lower, finds support on bar number 7, rallies a bit but can't hold it, retests the low on bar 11, rallies up vigorously on bar 12, holds for 2 bars, and then at 15, the market closes above these highs and looks like it might try to keep going. Now remember, I'm looking at it from the close of day number 20. But I noticed that it didn't follow through. I noticed that instead it held for 2 days and looked like it might have a chance of recovering, but it fell. And then on the next to last day, it recovers again and reverses upward and closes on a firm note. But no follow through at all on day 20, right back down. The message is that the market keeps having opportunities to reverse and go up. And every time it's in a position to continue upward, it fails. It failed over here on bar number 4. After bar number 4, it sure looked like we had tested and held, and it failed. Up here at bar 15, 16, and 17, it looked like it was holding and ready to go, and it failed to go. And then at bar number 19, it seems to be recovering. So for me, the inference is that the market is slip-sliding away, that it's got a problem. It's like a man who's trying to hold on the side of a gravel cliff. Every time he gets his foothold and reaches up, it slips out from underneath him. And that's what we see here. Over here we have something that we've already looked at on another chart, where the market came down very sharply, found some temporary support. I would draw a line under this low, and you see us break down here with great ease, close well off the bottom, but certainly the sellers are still in control at this point, and yet there's no downward follow-through. We erase almost all of this break. As we come back up to test and hold, I would be very interested in this market because it held the low, but it's a little bit too much risk. I like to get a situation that's closer to the danger point. I might have thought this looked good, and then it rallied away so fast I might have missed it. My vantage point is the right-hand side of this chart, that I've been away for 2 weeks, and now I'm looking at cotton, and I'm surveying what's been taking place, and I see certain things that have happened, like the action at day 1 with the shortening of the thrust, the failed opportunity after number 4, the failed opportunity after 15, 16, 17, the failed opportunity after day 19. Those are things that would make me feel that this market is indeed going to go lower. And I think March cotton has been down to 52 cents from here at $500 a penny. But that's how far it declined, yes. Well, when you're looking at intraday, you do have to take in certain considerations. There's a pattern to activity during the day. If you've watched intraday price movement, you know that in the first half hour to 45 minutes, there's a great deal of volume. The market is reacting to overnight news, reports, and so on. And then it tends to lessen towards midday, and late in the day we begin to build back as we get the market on close and evening up at the end of the day and so on. That's sort of the general pattern of trading activity in a normal day. But there are aberrations in that pattern. And if you're looking at intraday charts, it's good to know about those aberrations. For example, if you're looking at an hourly chart, normally the volume in the first hour is the heaviest of the day, like in the S&P E-mini. If suddenly you had more volume in the third hour than you did in the first, sometimes it tells you something obvious, that the market broke or rallied sharply. But sometimes it gives you a clue that something more covert or less overt is taking place. So it's good to know about things like that. So the milieu of the intraday chart obviously has subtleties to it that we don't have with dailies and weeklies. If the volume in the second hour through the seventh is heavier than the first, that's one intraday comparison. Another would be if the volume in, say, the third hour is the heaviest third hour volume in 10 days. I would take note of that. Sometimes these comparisons, what I call horizontal from hour to hour to hour, and vertical from time of the day, one day at a time, those kind of comparisons I think can be very useful. Time to go. We will start back tomorrow afternoon. Thank you very much.